Hey traders, welcome to another global macro update. We're going to start off with the economic calendar, go into some interesting thoughts on opening up the economy. I know it's not an easy task, obviously, but we're going to look at a few articles there, and then we're going to dive into economic charts from the Federal Reserve website, looking at different job openings in different sectors, and then we're going to finish it off with some talk with hyperinflation, looking at recent currencies that inflated significantly or went into hyperinflation. And then to end it off, we'll always end off with the charts here, looking at the Dow, S&P, and the US dollar index and all that good stuff. So we'll probably look at gold and silver too, but to start off, let's just quickly look at the PMI numbers that came out. We got those today. We're going to get some non-farm payroll on Wednesday, which is tomorrow, as well as some crude oil inventories. We got initial job loss claims, which haven't really impacted the market at all. The big one is, in my opinion, going to be the unemployment rate we see right here with the forecast 16%. Yeah, we'll see what that comes in on Friday. So now taking a look at the PMI numbers, which is the Purchasing Managers Index. Basically, a reading above 50% indicates the economy is generally expanding in the non-manufacturing sector, and then below 50% would mean that it is contracting. Now, we got the number of 41.8. The forecast was 36.8, which is very significant. So the forecast was actually below the low of 2008 here, and significantly lower than the low of 2001 and the dot-com crash. So the forecast was pretty aggressive. We didn't get that far down, but still 41.8% is significantly further than what we've been averaging here for the last while. And then the low in 2008 was 37.3. And then we're basically kind of at the high of the double top of the 2008 lows. So we'll see where this goes. It is going to be interesting. Next that I'm going to be talking about is opening up America. So Trump is talking about opening up non-essential services, and the economy is already kind of taken the next step there, where they have actually opened up some non-essential services, but it's a trade-off, right? I understand that, yes, there's a lockdown, and that would mean that people are not able to work, which obviously is very devastating. But if you've taken a look at some of the videos inside hospitals, or taken a look at some of the hospitals in New York as well, it's definitely very scary and very demanding for these healthcare workers. And, you know, if you are saying we should completely open up the economy and we should just basically run a Sweden type of approach of just keeping things open, letting people kind of go on their daily coffee or gym or whatever, whatnot. But at the end of the day, it is going to be a trade-off, because if you have that, more people are going to be dying. So without mass testing, contract tracing, and protective equipment for healthcare workers, all in critically short supply, the president's plan could be disastrous. So I do completely agree with mass testing. I think that's really important. A lot of people don't even know they have the virus, and then they'll go walking around, going on public transit, and doing all that stuff. Not really going to get like conspiracy kind of way, but contact tracing, you know, basically it's just the government knowing where everyone is, and making sure that people have their cell phones with them all the time, so then everyone knows, or the government knows where everyone is all the time. And yes, it is beneficial for these virus type events, but kind of makes you wonder if they just have the ability to be able to do this so quickly, why don't they just do this all the time? They probably do, but that's just for another time. But not going to get into this types of videos here, but definitely check it out if you are a type of person who just wants to open up the economy right away. There are repercussions for that action taken. Every action has a reaction, and the reaction for basically opening up the economy would mean a lot more deaths and hospitals getting so packed with individuals that they don't even have space to work, which is a trade-off that people have to think of. Alright, so Next thing we're going to be talking about is some employment numbers, looking at some non-farm payroll as well as some different job openings in different sectors. So this is the total non-farm payroll. We're going to be getting this number on Wednesday here, non-farm employment change. We'll see how it goes. Not really going to expect the market to move that much from this number, but it's still going to be an important number. This is an interesting chart that we're going to be looking at. This is the employment to population ratio, and it provides information on the ability of an economy to provide employment for those who want to work. So it's going to be for a certain amount of people, because you're not going to include children, you're not going to include older seniors, you're going to include just the people who are in the workforce at that time, who kind of are at a certain age that they're able to be able to provide some sort of product, service, some sort of productivity within the economy. So we see that the employment population ratio between the ages of 25 and 54 years old. So this is the bulk of the workforce, basically, people who are 25 and 54 years old. And we can see basically this is a percentage basis out of all the people who are within this group of individuals. And we can see the peak was 2000 during the dot-com boom here. That was the peak at, let's say, 82% of that group in the workforce actually working. And then we got a dip down. This is 2008 during the financial crisis here right before it. We had a high of around 80%, and then now we are dipping down, but we had a high of, let's say, 80% as well, 80.5%. So we're seeing a slow descent here in the number of people as a percentage who are able to actually work in the workforce, who want to work, who are eligible to work, who want jobs, who want to pursue careers in their field. We see that we are descending. And it looks a lot different from this picture right here. So it's very easy to look at that and say, I can't believe the economy is always growing. But if you're looking at it in a different perspective, where it's a ratio and you have the ability to look at different numbers to give you more perspective, I think that looking at different charts does give you more viewpoints in terms of looking at not just one chart and saying, wow, we've been growing so much, but you got to understand the demographic cycle is really pushing the increased amount of workers in the workforce. Yes, there's less people coming into the workforce now, but a large group of individuals coming into an economy definitely is going to create a lot of jobs. I thought this was very interesting. The next thing we're going to be looking at is a series of different job openings in different sectors. And the one thing I want to kind of show is the slowdown we had even before this COVID pandemic started. And we've been talking about a potential recession even before COVID became a worry, and even February, January in 2019, we were talking about an inverted yield curve. We were talking about negative interest rates in Europe and Japan. We were talking about basically the banks central banks giving banks money in the repo operations because they just didn't have enough liquidity. There was cracks already showing in the system, and I think COVID is just the lighter that ignites the fire that was already present, basically. You can smell the fumes. You just needed that lighter, in my personal belief. So let's go over some job openings here. First thing is going to be the manufacturing sector. We see 2008 was quite a bit of a slowdown, and the high of the job openings for the manufacturing sector was actually October of 2018 to maybe around August, summer and fall of 2018, and then we saw a descent from that period. So definitely some indication there. Job openings in the private sector here. Does it say? No, it doesn't really say much else. We see that the high, significantly higher than 2008 and even 2001, was around 66.87, somewhere around there. And then we've been slumping ever since in around December of 2018. So fall, winter, December of 2018, right around there, would definitely be the high, it seems like, that we've gathered so far. Same thing with the construction sector. We see that the high, April 2019, we've got 2018 in June with the ride up, and then we've seen a significant slowdown in the job openings in construction since April 2019. Right, April, May, June, July, when we've seen a slow descent down. Durable goods manufacturing. We see the high November of 2018, and then we've seen a slowdown in the number of job openings in this sector. We got a significant slowdown in 2008. We are basically at the high from the dot-com era at around 329. 317, so close, but we are seeing a significant slowdown in the job openings in this sector as well. Retail trade, we saw a spike here reaching a peak in November of 2018, and then we've seen a significant slowdown here in the number of retail trade job openings, like many others. Leisure and hospitality, we saw a peak in around January of 2019, higher than 2008 and 2001 significantly, and then we've seen a slow descent here. Not too crazy, but this number is only showing February 2020, so I think it will be a significant move when we do get March and April, because those are obviously two very, very badly hit months for the lockdown. Trade, transportation, and utilities. The peak was November 2018. Previous one was May 2018. We saw that's much higher than 2008, but we are seeing yet again a bit of a slowdown in this sector. Accommodation, food services, same thing. Peak was January 2019. Seen a slowdown. Mining, logging. Peak was around July 2019, although it's very, very choppy. We are seeing a pretty significant slowdown here as we get from 40 to 13. So it's a huge drop here in the level of thousands for the mining and logging job sector. Now we're going to talk a little bit about delinquencies. I know that this is a little bit shift in subject, but we've been talking about people not being able to pay their rents and mortgages and how this is a domino effect to end up on the banks, basically, because if you can't pay your landlord or your real estate manager or whatever the case may be, that person probably has some level of debt at the bank because he is refinancing his home, purchasing a second one, third one, fourth one. Real estate is something that is extremely levered up. You're using a significant amount of leverage when you are dealing with real estate for the most part. I don't really hear many people put down a significant amount if they are in the real estate game because they're trying to expand their portfolio to get and generate greater cash flow, and that's kind of how they grow. And as long as things are working and things are moving and there's oil and grease in the gears, that's not a problem, because if cash flow is coming in, hey, that's not a problem. But if something like this happens and people are not able to pay rent, and if you're leveraged up a significant amount and you're expecting a certain amount of cash flow to come in and it's not, and you can't pay your mortgages, that kind of seems like that's a recipe for disaster for a lot of individuals, especially with the new age of Airbnb. And I know a lot of people were super hosts. I've been reading about that, reading about some really difficult times for people who have really leveraged up to buy a tremendous amount of apartments or townhouses or homes in highly desirable areas and rent them out on Airbnb. Sounds like a great idea. Probably was until, obviously, something unthinkable happens like this. Final topic we're going to talk about is the monetary base here. We see it growing basically in an absolute straight line, more aggressive than we've seen when we initially started back in 2008. Just a basically straight line here. Give me one moment. And a lot of people are talking inflation, hyperinflation. We've already talked about why we think it's going to be difficult for inflation to occur initially due to the velocity of the currency dropping so significantly, due to the fact that individuals are possibly going to become savers, less consumers, at least for the short little while, until people gain their jobs back, people gain a little bit of savings, so they have some cushions, though if something happens, they're not instantly asking the government for money, there's going to be a lag time where velocity is going to slow, and there's going to be a deflationary mindset among individuals living in the United States. Because, excuse me, a deflationary mindset is saving, not consuming, understanding that there could be a rainy day, and then a consumer mindset, which is more inflationary, is borrowing, basically consuming, purchasing items that you would later down the line now by even going into credit or debt, and basically creating aggregate demand. That is how prices increase, and that's what the federal government would like. So we've talked about it many times before. We do have our reasons why there's going to be deflation first, and then once things look a little bit more normal, there will be inflation, but then we could see significant inflation or even hyperinflation due to the fact that one of the variables for the hyperinflation theory is valid, which is the significant money printing. The other side is going to be the velocity of the currency, how much it's transacted, how much it's used, because that's going to play a vital role in how much prices and goods and services actually go up. And also, to add on that, there's different forms of inflation. Like 2008, people said there was no inflation at all. That is incorrect. There was inflation in financial assets. There was inflation in real estate. You just didn't see it in your CPI numbers that much. You just didn't see it in your everyday goods and services. But things did inflate. But that's mainly because the federal government, central banks, gave the newly printed money to banks, and what did they do with it? They're going to purchase equities. They're going to purchase real estate, which, you could purchase an equity which is underlying a real estate company or something along the lines of that. So that's where the money went, and that's where you saw inflation. But now you're giving it to everyday individuals with these stimulus checks. So that's a larger pool of currency fighting for the same amount of goods and services. And if that amount of goods and services shrink, like we're seeing now with the supply chain shock, that could even significantly increase the inflation if it does come later down the line. But for now, I do think that there's a higher probability for deflation rather than inflation due to the stuff that I did talk about. So this is a chart showing Venezuela's money supply in trillions of Venezuelan bolivars. I think that's how you say it. So it seems like it is unbelievable, but the U.S. monetary supply is not that far off. If we're looking within the recent time frames, that's a crazy move. We went from 3.2 to almost 4.9. And we can see right here, it's not unbelievable. 2 to 4, 4 to 8, 8 to 12. It doesn't seem like it is unfathomable for the United States dollar, to be completely honest. And we can see that Venezuela versus peers, this is the percent change year over year versus Colombia and Brazil. They're actually decreasing, whereas the percent change, obviously, for the bolivar hits over 150% for a year-over-year change, which is pretty unbelievable. Next thing we're going to look at is all the different hyperinflations that have actually occurred in the last 25 years, I believe. Yeah, 25 years. And, you might not hear about all these different currencies basically exploding or debasing so much that they are absolutely worthless. This is what a hyperinflation is you have so much currency that it becomes absolutely worthless to anyone. And it's just literally a piece of paper, like a napkin. You don't value a napkin, I don't really either, because of the fact that no one else has confidence in that napkin being able to store value for a long period of time, and a means to transact goods and services. So let's just look a little bit down the list. Zimbabwe, I'm sure we know that one, mid-November 2008. Highest monthly inflation rate. That's unbelievable. Time required prices to double. 24 hours. That's crazy. So if you go to a store today and ask for an apple, it'd be like $100 in Zimbabwe currency or whatever, and then the next day it'd be $2. Literally, that's unbelievable. Germany, October 1929. We got Greece, 1944. China, 1949. We got Peru 1990, France 1796, China 1945, Poland 1929, Venezuela 2016. I wonder if there's any other ones that are recent. Not really. Belarus 1994, Kazakhstan 1993. Some of these are pretty recent here. Yugoslavia 1989. So you might not think that these happen too often, but they do. And I'd rather be overprepared than underprepared, and things that do well in hyperinflations generally are going to be safe haven assets like gold and silver, and potentially cryptocurrencies, due to the fact that they have a limited supply of let's say, for example, Bitcoin that is able to be created, and it's in time a deflationary asset, meaning that there's going to be less and less Bitcoin created every 4 years until there's going to be a point where there's going to be no more Bitcoin created ever. And the most there can ever be is less than 21 million. There's actually less than 21 million due to the fact that people losing them, people sending them to wrong addresses and wallets, and all that stuff. So, you know, if you are not interested in cryptocurrencies, definitely look into it, because I can't advise anyone to invest in cryptocurrencies, but I do think that they do have a lot of merit and efficacy as a potential means for not completely changing the monetary system, but playing a key role in the next financial system that we are going to have play out after fiat currencies, because it's unsustainable to have this sort of price print, or this sort of money printing without any sort of reaction. And we've seen velocity decrease, but I just think that it's improbable for this to continue on forever. And I do think that it'll probably end in my lifetime, so having an understanding of the potential outcomes of this inevitable spiral is probably a positive thing. Last thing we're going to touch on before looking at the charts is a little quote that we have from Dinar Dirham, I think that's how you say it. According to a study of 775 fiat currencies by dollardays.org, there is no historical precedence for a fiat currency that has succeeded in holding its value. 20% failed through hyperinflation. 21 were destroyed by war. 12% destroyed by independence, and 24% were monetarily reformed, and 23 are still in circulation, approaching one of the other outcomes. The average life expectancy for a fiat currency is 27 years, with the shortest lifespan being 1 month. Founded in 1649, the British pound sterling is the oldest fiat currency in existence. At a ripe old age of 317 years, it must be considered a highly successful fiat currency. However, success is relative. The British pound was defined as 12 ounces of silver, so it's worth less than 1/200th, or 0.5% of its original value. In other words, the most successful long-standing currency in existence has lost 99.5% of its value. I'm sure if you follow this channel, you understand the destruction of wealth that comes with only holding fiat currencies for an extended period of time. You will get the Federal Reserve, central banks, to debase your currency. It is a fact. Unless you're living in a country that doesn't print money out of thin air, like we've seen in basically every single first world country, you are basically going to be losing your wealth little by little between your hands if you do not invest your money somewhere. So that's going to be the video for the fundamentals, kind of talking about news articles that pertain to global macro, as well as a little bit more details into how the health of the economy actually is, because we can talk about news articles, news stories, what analysts say all the time, but I try to present unbiased information about the economy using raw data. That's, in my opinion, a really good way to go about trying to conduct proper analysis. So now we're going to go on to the charts. One thing I do want to actually go through, we did this on the Bitcoin charts, and we're going to do one on the SPX 500 as well. So this is the normal chart that we have right here, but we're actually going to be inverting the chart. So instead of having, obviously, up is up and down, we're going to flip the chart around. So now we have the S&P 500, but this is now inverted. So it just looks like a massive pump to the upside here. And this should look, in my opinion, pretty bullish here. And we can even go back to the daily and we can see a huge spike. And in the long run, it should look bearish because the S&P does look extremely bullish. But if you're looking at the weekly, the daily, all that stuff, just in terms of if you're looking at decades, well, we can see this is basically the inverted chart for the S&P 500. So now let's look at what we can see right here. Initially, I'm not really going to be going over TA too much, but let's just go with the fib retracement first. Go to the very, very top and go up to the candle closure right there. I'm just going to delete this, and delete this. All right, so now we have the fib levels. Let's just make that a little bit closer in right here. And what do we initially see? All right, so let's get our snip and let's talk about this potential structure we have on the S&P. This is flipped, so it's going to be very similar to what we're seeing for the normal charts, but we're just flipping it so we have a different perspective of the market. So one thing to note, we do have a very important zone at the 618, which is a key level of resistance right here, which shows the significance of this zone, which turns into a possible level of support. So that, in my opinion, is the first zone that we're going to be looking for, or potential reversal pattern. Next thing we see is a wedge of some sort. We did see this descending zone right here that got broken. We have two zones. Initially, it was like there, and then we made a smaller low. So let's just erase that. And now the way I see the chart is potentially like this. So we're not looking for an entry just yet, but we did break this wedge, which in my opinion is a positive outlook for the charts. And now what we're looking for is a potential higher low. This was a low. We're looking for a higher low for the market structure to shift from a series of lower lows and lower highs to a consolidation, to a potential move to the upside. So what do we need in order for that to occur? We need to hold a low. So ideally, I'd like to see the price hold above the 618. Probably below the 50% here. Ideally, maybe around here, like where we are right now, to show a potential reverse head and shoulders pattern. So we see a left shoulder right here. We see a head right here. And if we see the price hold this low and create a higher low, that would potentially create a head and shoulders pattern, a reverse head and shoulders pattern, and a breakout area would be around here at 2760, 2750. So then that would be a potential reversal that we would see. We have our first potential take profit here at the high because we had a massive move. I wouldn't be surprised if we do test those highs again. And then we have some extensions here on the fib levels if we do get beyond that. But now let's look at the 4-hour chart to a little bit further discuss this trade. I'm just going to move this to see if we get anything. Not really. All right. Now that we understand the fib levels, we're going to look at the key potential hold that we want to see for the support, which would be right around here. So I'm looking for around the 2882. So let's get our little price label right around there. That's what I really want to see the price to hold, because we can see a potential head and shoulders like this. So that's what I'd be looking for, something along the lines of that. And then we have a nice potential breakout zone right around here. And that would be the structure that I'd be looking for. Yeah, we can put a descending zone potentially, but I don't really mind waiting for a little bit longer for more of a confirmation. But in order for, in my opinion, the price to move from a downtrend to an uptrend, we need a zone of consolidation where we have volume accumulation coming into the market. and then we're looking for that nice price action pattern that's going to give us the break, as well as the market structure that allows us to have more confluence within our trade. And ideally, we would even potentially have a series of higher lows connected right there, maybe with like a ascending trend line connecting the higher lows. That would be really nice to see, and then be looking for that entry at around 27.30 with a retest. That would be really ideal to see. So that's going to be the TA for the reverse inverted chart of the S&P 500. I hope you can see the similarities that we have for this inverted chart analysis with our normal chart that we can see right here. I have the exact same mindset for what I'm looking to trade. I want to see the price hold the around 27 or 28.89-ish zone, and then if we're able to hold that, that's going to create the right shoulder for the head and shoulders pattern, and then the breakout zone would be around 27.50 would be the key level for the neckline for the price to break in order for me to look for entries to the downside for my major short. So that's going to be the analysis. I'm sure you can see it right here. Let's just quickly draw it with the brush. So you got the run up, you got the left shoulder, you got the head, you got the right shoulder. We may get a little bit of a bounce, but that's something that we're going to be looking for. And then, like I said before, some ascending zone or some descending zone in this case would be, in my opinion, a really good way to have confluence. And if we get a break to the downside and a retesting that previously resisted zone yet again for another level of resistance, that would be an extremely high probability, dependable trade that I would be taking in my personal view. So we got a couple options here. I think we got a little bit of time to wait until that actually occurs. It is obviously earnings season, like I said before, so I think the actual underlying health of corporations in the United States will be shown with the quarterly reports coming in, and yeah, we will see how it goes. Not really going to do anything right now, but we really hope you enjoyed the video. If you found these, or if you found this video and the videos previous to be useful, educational, informative, entertaining, it'd be great if you would subscribe to our channel. We do provide videos on a weekday basis, or every day on the weekdays. We do provide videos talking about our trades, talking about more economic things, more ideas about what could happen in the future, looking at the past, and kind of dissecting the financial markets really in a nutshell, and talking about cryptocurrencies as well. So we really hope you enjoyed it. If you have any questions, please leave a comment down in the comment section below, and we will be sure to answer any questions that you may have if they pertain to something related to what we're talking about today. So thank you very much for watching, and until next time, have a good one.